Hey everyone, Dave Keller here with Market Misbehavior. Today we're going to talk about the great rotation of 2023. So the first half of 2023, the story of the equity markets here in the US was all about growth, particularly mega cap growth versus everything else. This is one of those times in market history when a relatively small number of large companies really dominate returns. So if you look at the first half of this year, sort of January through the end of June, you'll see that those mega cap leadership names like Apple, Microsoft, Amazon, Netflix, Nvidia type of stocks did incredibly well, logging in some cases over 100% gains in the first 6 months of the year, while the average stock was actually languishing. Now that really started to change in June into July, where you started to see other stocks start to participate as well. Energy, industrials, materials, even some healthcare, financials actually started to improve a little bit. Now, all of a sudden, July into August, I think we're set at the beginning of what I would call the great rotation of 2023. You're seeing a rotation away from the dominating mega cap growth stocks that have led the way here, charts like Apple and Microsoft, which have broken down. Recently, Apple and Microsoft both broke through their own 50-day moving averages. As of the end of this week, the QQQ closed below its 50-day moving average as well. So what does this rotation really mean, and what other stocks are actually starting to do particularly well? Before we get to the charts, if you like the sort of thinking about technical analysis, market structure, and investor psychology, go ahead and subscribe to my channel. Also, give the video a like if you appreciate it. We would super appreciate that back. Put a comment below. Which of these ETFs that I'm about to share with you do you think has the best opportunity over the next 1 to 2 months, and why? Now, we're starting with the chart of the S&P 500 just to sort of set the stage. Now, if you've been following my channel, we tend to talk about market returns pretty regularly. You probably have a good sense of what the S&P has been doing. But if you've been off on a beach somewhere not paying attention to the markets, we made a pretty major low there in October of last year with the S&P just touching that 3,500 level before pushing back to close a little bit higher. From there, from the fourth quarter of last year through really the end of July of this year, it has been a lights out uptrend for the most part for our major benchmarks. Besides a pullback in December, a pullback in February into March, overall pullbacks have been fairly shallow and brief. And overall, the momentum in the market has continued higher, particularly at the end of May when the S&P finally got above the February high around 4,200. That really confirmed this upswing. Now, again, you have to remember during this period, the biggest momentum, or I guess the stocks really making that the benchmarks go higher were those mega cap stocks. And I tend to think of Microsoft and Apple, the two biggest weights in the XLK, as perfect examples of that mega cap leadership trade. Now, June into July and now into August, we've seen a lot of those stocks start to come down. Semiconductor stocks have been struggling here recently. Other growth sectors, technology, communication services have all been struggling a lot more here on a relative basis. As a result, even though some areas of the market are actually doing okay, our major benchmarks, which are really dominated, they are very top heavy to those mega cap names, it's pulled back. And now the S&P is kind of at a key decision point, right? We've sort of pulled back to an ascending 50-day moving average. And the question is, do we hold that and move higher, which is a common technical pattern that we see looking at equities and ETFs, or do we break lower? And one of the reasons why I'm not particularly confident in the S&P finding support at its 50-day is because about 30% of the S&P 500 members have already broken down through their own 50-day moving averages in the last 6 weeks. So the other thing we want to look at then is rotation, right? So if that is the rotation lower in the markets just in the last couple of weeks, and if this is the beginning of something further to the downside, what about the different sectors that comprise the S&P? What are they doing? Well, one of my favorite ways to look at sector rotation is using Julius de Kempeter's relative rotation graph, or RRG. And I followed Julius in his work for many years. It's a brilliant way of just visualizing the idea of sector rotation. Anyone that's invested for a while, how sector rotation tends to happen. There's a cyclical nature of outperformance and underperformance between different sectors and themes over the business cycle, the economic cycle. This just visually represents that rotation very well. So if you look at the end of March, this is what the weekly RRG looked like. So this is the relative rotation graph using weekly data. In the leading quadrant, meaning sectors that are outperforming with improving momentum, two sectors, the XLK and the XLC, technology and communication services. The only one in the improving quadrant, which is, still underperforming but starting to really rotate higher, the XLY, consumer discretionary. Everything else kind of below the zero line. And you can see in the weakening quadrant, industrials and materials, which means they're still okay, but starting to weaken momentum-wise. And then the underperforming sectors are down here in red in the lagging quadrant, and that's pretty much everything else. Healthcare, energy, financials, defensive sector like utilities, and consumer staples all sort of in this area. Now, what's really cool is we can actually put play on this. Look at what happened as we go through April, and then we go into May and June, July, and now August. Those growth leadership sectors like XLC, XLK, XLY, now all rotating down. So still outperforming, but the momentum is completely weakening. The XLK in particular is heading southwest, what I call the direction of deterioration. It's actually starting to underperform here. Everything else now starting to rotate in more of a position of relative strength. Industrials, materials, financials, energy, healthcare, real estate, all in the improving quadrant and heading northeast, suggesting that they're really starting to enter into a period of outperformance. Now, what's really interesting is we can then dig into the sectors a little bit further. Energy is one of those sectors where I've seen individual groups that have popped higher, and I run a regular scan for stocks and ETFs making new 3-month highs and those making new 3-month lows, because I think that's a really good working list of charts. Things that are starting to work, many of the times they've been in sort of a basing pattern, they start to improve, entering what I call a new accumulation phase. And the new swing lows scan can help me identify things that had been working but are now starting to roll over. Here's the XOP, which is an oil and gas exploration and production ETF. And you can see that the uptrend really started in May of this year. May kind of sideways, then June, July, August, really accelerating. Think of the chart of Microsoft, Apple, sort of names. Those stocks actually did very well into July, but started to rotate lower. So energy stocks like the XOP have actually continued in July, but also into August as well. So while the growthy stuff is kind of rotating lower, energy is actually pressing to the upside. It's actually accelerating. Now, another way we can think about the performance of these groups is by looking at relative strength. So here I'm looking at a series of 4 ratios, each of these ETFs relative to the S&P. Here I have 2 ETFs from the energy sector, the XOP, which is oil and gas exploration and production, and OIH, which is oil services. Tracks an index called the OSX, if you're familiar with that. This is basically showing the relative strength. So if this line is going up, that group or that ETF is outperforming the S&P. If the line is going down, it's underperforming the S&P. Look at how the relative strength of these groups in May and June was essentially flat, meaning the group, the industry, and the S&P 500 were basically in line. They were doing the same thing. But look at how July and now into August, the relative strength lines are really going up. What that means is for the last 6 weeks, really 8 plus weeks, both of these groups, oil services and exploration and production, have been outperforming the S&P 500. During that same period, look at the relative strength line of 2 ETFs that track technology stocks. The IYW is very similar to the XLK, tracking a broader technology sector, but again, tends to be pretty overweight the mega cap names like Microsoft and Apple. And then the SMH, which is the semiconductor group, which includes NVIDIA and then a bunch of other semiconductors as well. In many cases, pretty legitimate sized large cap companies as well. While the relative strength in energy has been pushing to the upside, the relative strength in these technology ETFs has actually been rotating lower. So when I think about the great rotation, it's not just the S&P 500 rotating lower, which I think has happened and I think will continue to mostly happen. When the markets themselves are rotating lower, it's often fueled by rotation. And because those growth sectors have dominated so much on the way up for most of 2023, and because those stocks are such a big weight in the index, as they start to roll over, which they are, it's dragging our benchmarks down. And it's not just about the top level sectors. If you go a little bit further down and even look at other industry related ETFs within those different sectors, some growth oriented ones and some value or cyclical oriented ones, you'll find that in general the cyclical groups like some of the energy stocks that we mentioned versus the growthy stuff like technology, semiconductors as an example, it's a clear illustration of how this great rotation is basically where risk is or positioning is being moved from the growth leadership that has gotten us to the high in July to some of the other areas of the market that have been underperforming but are really starting to emerge. And here's the punchline. I was taught that if you want to outperform your benchmark, you need to own things that are outperforming your benchmark. For now, areas of the market like energy are really getting it done on a relative basis. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. We'll talk to you again soon.